Hey everyone, I'm David Finz, and on this episode of the Cyber Insurance Imperative, we're going to take a closer look at the recent report on the cyber insurance market issued by the National Association of Insurance Commissioners. I would describe this report as one small step, one giant leap. The small step is with respect to the slight improvement in the insurance carrier loss ratios year over year. Now, for those of you who are unfamiliar with the concept, underwriters tend to measure the profitability of their book of business as the ratio of losses they paid out relative to the premium they've taken in. Because of overhead and other expenses, they typically try to keep this ratio below 60 or at most 65%. And we see that in 2021, the loss ratio for the top 20 insurers decreased from 66.9 to 66.4%. This may not seem like much of a change, but considering some pundits were convinced not very long ago that the sky was falling for cyber insurance, any improvement is welcome. And it's even more telling when you drill down into the loss ratios of individual carriers. The NAIC report indicates that 4 of the top 10 cyber insurers and 10 of the top 20 were able to keep their loss ratios below that 60% threshold, indicating that they have found a way to continue to offer this important product to policyholders and to do so profitably. Ironically, the two markets with the highest loss ratios both saw their rankings drop year over year as measured by premium volume. It seems that shrinking your cyber book is not a path to profitability. For those markets that have chosen to grow their book rather than pull back, most have been rewarded with healthy loss ratios. And that's because their underwriters have become astute in the underwriting of this coverage. And the NAIC report acknowledges this. Quoting directly from the report, it says, because of the increasing cybersecurity risks, businesses are facing a more demanding underwriting process. Insurers are more thoroughly examining a company's security controls, internal processes, and procedures concerning cyber risk. Additionally, underwriters are more cautious in examining an insured's risk presented by the third parties working or contracting with the insured. Now, as anyone who has been through a cyber insurance renewal over the past 12 months would certainly attest, the process has become much more demanding. And while this may be inconvenient, it's a good thing for the long-term sustainability of the product. And brokers have had to up their own game in terms of the preparation that is required for clients in the run-up to their annual renewal. Now that's the small step. The giant leap has been in the growth of premiums. The NAIC report indicates that direct written premiums increased by 75.3% in 2021 from the year prior. Now, of course, this second finding is not entirely unrelated to the first. One reason for the improved loss ratios is undoubtedly that underwriters have adjusted their pricing. But if demand for the product is dampened, you wouldn't know it from the number of policies issued. That figure also increased by 31.8% year over year, according to the NAIC. So what you have here is a vibrant market for a coverage that businesses recognize they need and are willing to pay for, and that insurers have become savvy about underwriting. We're looking at a market that now stands at $4.8 billion in premium, and that tells me cyber is not going away anytime soon. Now, please don't misunderstand me. Nobody likes to pay more for their coverage or to go through a more rigorous application process, but insurance brokers, the smart ones anyway, need to serve as trusted risk advisors that can help businesses identify the controls that really move the needle in the eyes of the underwriters, and to connect clients with service providers that can help get those controls in place. This allows the business to be positioned in the most positive light and to secure the broadest possible coverage at a fairly priced premium. If you're looking for that kind of service for your insurance needs, you can DM me on LinkedIn or email me at david.finz@alliant.com. It's just one more way that Alliant helps you find the more rewarding way to manage risk. Thanks for watching.